Is the real estate market going to crash? Many Americans may be worried about a real estate market crash. They are concerned about the unexpected impact of the COVID-19 pandemic on housing prices. At first, the 2020 stock market crash worsened those fears as home sales tumbled. Then, housing sales unexpectedly turned up, hitting new highs. People who were caught in the 2008 financial crisis may be spooked that the pandemic will lead to another crash. That's unlikely. According to an interview with Selma Hepp, Deputy Chief Economist at CoreLogic, there is not the same oversupply of homes this time. Instead, there is an undersupply. 10 warning signs of a crash. There are 10 signs of a housing market crash. The first 5 are critical. They are when an asset bubble bursts, unregulated mortgages increase, interest rates rise rapidly, the yield curve inverts, and Congress changes the federal tax code. The other 5 signs could contribute to a crash, but are less critical. They include a greater number of house flippers, warnings from experts, fewer affordable homes, and a return to risky derivatives. Let's look at each more closely. 1. Asset bubbles burst. Most crashes occur after an asset bubble has burst. One sign of a potential bubble is rapidly rising home sales. In February, existing home sales reached a pre-pandemic peak. Homes were selling at an annual rate of 5.76 million a year. That all changed after the national emergency was declared. Sales of homes plummeted to a rate of 3.91 million units in May. Surprisingly, the pandemic then boosted home sales. Families that could move out of crowded cities headed to less densely populated areas. Those who worked at home also wanted larger spaces. Thanks to the Fed's actions, interest rates were at 50-year lows. This further spurred demand. By July, the sales rate reached 5.86 million homes. By October, it had blossomed to 6.86 million, beating the pre-pandemic peak. Home prices also suggest a housing bubble. The pandemic hasn't slowed home prices at all. Instead, they've skyrocketed. In September 2020, they were a record to $126,800 according to the Case-Shiller Home Price Index. The pandemic has created high unemployment rates. This could lead to foreclosures, as people can't afford to pay their mortgages. But that is unlikely to affect the housing market in 2021. According to Hepp, the foreclosures that do occur in 2020 or 2021 won't affect the market until 2022. She said, "It will take that long for the houses to go through the foreclosure process and affect the market." 2. Increase in unregulated mortgage brokers. Another concern is when the number of unregulated mortgage brokers increases. In 2019, they originated 54.5% of all loans. That's up from 53.6% in 2018. 6 of the 10 largest mortgage lenders are not banks. In 2018, 5 of the top 10 were unregulated. 3. Rising interest rates. Higher interest rates make loans more expensive. That slows home building and decreases supply. It also slows lending, which cuts back on demand. Overall, a slow and steady interest rate increase won't create a catastrophe, but quickly rising rates will. Higher interest rates preceded the housing collapse in 2006. Many borrowers then had interest-only loans and adjustable-rate mortgages. Many also had introductory teaser rates that reset after 3 years. When the Federal Reserve raised rates at the same time they reset, borrowers found they could no longer afford the payments. Home prices had fallen, so these mortgage holders couldn't make the payments or sell the house. As a result, default rates rose. The history of the Fed funds rate reveals that the Fed raised rates too fast between 2004 and 2006. The top rate was 1.0% in June 2004 and doubled to 2.25% by December. It doubled again to 4.25% by December 2005. 6 months later, the rate was 5.25%. The Fed has raised rates at a much slower pace since 2015. 4. Inverted yield curve. A warning sign for the real estate market is when the yield curve on U.S. Treasury notes inverts. That's when the interest rates for short-term treasuries become higher than long-term yields. Normal short-term yields are lower because investors don't require a high return to invest for less than a year. When that inverts, it means investors think the short-term is riskier than the long-term. That plays havoc with the mortgage market and often signals a recession. The yield curve briefly inverted in February and March 2020. On March 9, 2020, the yield on the 10-year note fell to 0.54%, while the yield on the 1-month bill rose to 0.57%. The curve later returned to a normal shape. By Dec 18, the yield on the 10-year note was 0.95%, while that on the 1-month bill was 0.8%. 5. Changes to the tax code. The housing market responds dramatically when Congress changes the tax code. Initially, many thought that the Tax Cuts and Jobs Act could have a negative impact on housing. The plan raised the standard deduction, so many Americans no longer itemized. As a result, they couldn't take advantage of the mortgage interest deduction. For that reason, the real estate industry opposed the TCJA. Research has shown since then that the tax changes had little effect on the housing market. Reduction in home purchases by middle-income families who took the standard deduction was offset by other income groups. The law doubled the standard deduction, giving more income to low-income families, who could then afford a home. High-income families continued using itemized deductions. Other tax cuts also made them more able to buy new homes. 6. Banks returned to using derivatives. The real estate market could collapse if banks and hedge funds returned to investing in risky financial products to the extent they did in 2007. These derivatives were a major cause of the financial crisis. Banks sliced up mortgages and resold them in mortgage-backed securities. Over time, the MBS became a bigger business than the mortgages themselves. So, banks sold mortgages to just about anyone. They needed them to support the derivatives. They sliced them up so that bad mortgages were hidden in bundles with good ones. Then, when borrowers defaulted, all the derivatives were suspected of being bad. This phenomenon caused the demise of Bear Stearns and Lehman Brothers. 7. Increase in flipped homes. Home flipping played a major role during the 2008 recession. Speculators bought homes, made moderate improvements, and sold them as prices continued rising. In 2006, flips comprised 11.4% of home sales. Flipping has slowed considerably. In the third quarter of 2020, 5.1% of all home sales were bought for quick resale. That's down from the 6.7% of sales in the second quarter of 2020. It's also lower than the post-recession high of 7.2% in first quarter 2019. The decline in flipping is due to the reduced inventory of housing stock. At the same time, flipping has become more profitable. Atom Data Solutions reports that the pandemic's effect on flipping is contradictory and difficult to forecast. 8. Affordable housing plummets. A booming housing market sends home prices rising. Another sign of a housing bubble is that the availability of affordable housing shrinks. Housing growth outstrips income growth. There are signs that this is happening. In 2017, only 39.1% of rental units across the country were affordable for low-income households. That's down from 55.7% in 2010. The shortage is the worst in cities where home prices have soared. 9. Rising sea levels. Regional real estate markets could collapse in coastal areas vulnerable to the effects of rising sea levels. At least 300,000 coastal properties will flood 26 times a year by 2045. The value of that real estate is $136 billion. That affects the value of 30-year mortgages currently being written. By 2010, 2.5 million homes worth $1.7 trillion will be at risk of chronic flooding. Properties on both coasts are at most risk. In Miami, Florida, the ocean floods the streets during high tide. Harvard researchers found that home prices in lower-lying areas of Miami-Dade County and Miami Beach are rising more slowly than the rest of Florida. Properties at risk of rising sea levels sell at a 7% discount to comparable properties. Most of the property in these cities are financed by municipal bonds or home mortgages. Their destruction will hurt the investors and depress the bond market. Markets could collapse in these regions, especially after severe storms. 10. Officials warn of a housing crisis. Official warnings are the least critical indicator of a housing market collapse. They can often get it wrong, too. For example, William Poole, a former president of the Federal Reserve Bank of St. Louis, warned of a subprime crisis in a March 2017 op-ed. He based it on the fact that 36% of Fannie Mae's loans required mortgage insurance. That's about the level in 2006. On the other hand, Poole correctly warned of the subprime crisis in 2005. In short, pay attention to an official warning of a housing crisis when many of the other indicators are also flashing red.